So we are back again. So we will do this every 40 minutes because the maximum that we can record on Zoom is for 40 minutes. Okay. So we are, and I also would like to remind you that at the end of the class, then I will be taking your attendance. So please be online until the end of this online class. Okay. So we were talking about the gains from trade. Then let's continue. Then this is our second objective of this first chapter. So we've said we'll be talking about international and domestic economic issues and trade issues is the first objective. The second objective is to talk about these 7 themes that reoccur in international economics and international trade. And the third one is to talk about trade and the monetary transactions and how this international trade is different from international finance. Okay, so as we've said here, both countries or nations that are involved in selling goods and services to each other always are mutually benefiting from the trade. But because as I've said, every country has their own comparative advantage. There are something they can produce and there are things that they cannot produce or they have hard time producing. So as we have said, countries should produce those goods and services and sell it to the other countries, and other countries who are good at producing other goods and services should produce and sell it to the others. Okay, so as we have said, comparative, for example, last time we said that the Middle East has a comparative advantage of producing petroleum and oil and sell it to other countries, but at the same time these countries also import like automobiles or other machines from other countries. Okay, so that is the first reason, but there is also always a misconception. Okay, for example, developing countries always complain that international trade creates a high competition. Okay, because as we have said, businesses are now competing globally. So those small businesses, for example, in Korea, are going to compete with those big ones in other countries because now consumers in Korea can buy these products from other countries. Okay, this makes the competition very difficult for small businesses. So this is one misconception. And the other misconception would be from the developed countries. So, for example, the US might say that product is imported from Europe or from Asia are low in quality, so they might affect our living standard. Okay, so there is a misconception in both developing and developed countries on international trade. But still, if the theories and policies of international trade are interpreted very well, then both countries involved in international trade will benefit. Okay, so this is one. The other is, how could a country that is the most or the least efficient producer of everything gain from trade? That is the other topic, I mean the other point that we have to discuss in gains in trade. So countries use finite resources of their own to produce what they are most productive at, okay, compared to their production choices. Okay, so then trade those products they are good at for goods and services they want to consume from other countries. Okay, so we will talk about some specific issues that might be that we can argue with, in terms of how trade and non-trade barriers are treated by countries. But for now, from the gains of trade, we can say that countries who have finance resources to produce goods might produce them and sell it to those countries who are not in a good shape to produce these products. Okay, so countries can specialize actually in production while consuming many goods and services through trade. Okay, so one other concept here is specialization. Okay, so as we've said, a country cannot produce everything that its people can consume. Okay, but a country can specialize on some of the goods so that this goods produced in this country can be very much competitive in the international market. Okay, so specialization is one important thing, and the benefits of international trade are not always tangible. Okay, or they are not always something that you can feel. Okay, there are also intangible benefits of international trade, like international migration could be considered as intangible benefit, or migration of money in lending or borrowing could also be considered as intangible benefit in international trade. Okay, so this first, the second issue in gains from trade is a country can specialize on few of the production of goods and services so that they can be internationally competitive. Okay, and the third issue is trade benefits countries by allowing them to export goods made with relatively abundant resources and imported goods made with relatively scarce and import goods which are made relatively with scarce resources. Okay, so last week, if you remember, as I've said, for example, the textile industry is highly dominated by Chinese. Okay, the reason is because Chinese have abundant human resource. Okay, so because the textile industry requires a huge number of labor, then and Chinese, they have too many people, they can engage these people in producing textiles. Okay, so that is where the abundant resource lies. And Chinese might have scarce resources in producing other products, so the Chinese should import these products from other countries. Okay, and the fourth is when countries specialize, they may be more efficient due to large production scale. Okay, or large scale production. So when a country specializes in few goods, then they can have economies of scale advantage, which means because their products are now very competitive in the international market, they can produce more of these products, and in producing more, then you have the advantage of economies of scale. Okay, which means when you produce more, the cost of production decreases. Okay, which means this will improve your profit from the production. Okay, and the other issue here is countries may also gain by trading current resources for future resources. That is international borrowing and lending due to international migration. Okay, so this could be considered as an intangible benefit of international trade. Okay, so we'll talk about how international borrowing and lending can be done using current capital markets and also futures markets. Okay, so, and the other is trade is predicted to benefit countries as a whole in several ways, but trade may harm particular growth. Okay, so when we say we are engaged in international trade, it's not always the case that we benefit from the international trade. As I have said, there is no problem with the international trade as a concept, but while implementing these theories and policies, some countries might be harmed in being engaged in international trade. Okay, so international trade can harm the owners of resources that are used relatively intensively in industries that compete with imports. Okay, so trade may therefore affect the distribution of income within a country. Okay, so we'll talk about these issues when we talk about subsidies. Okay, for example, let's say we have farmers in Korea. Okay, and these farmers are not using modern ways of producing products. Okay, so that means the cost they incur to produce this product is high, because they are using very traditional means of producing these products. Okay, but let's say a farmer in the US is using very modern production system and produces a lot of this products, goods and services. Okay, let's say goods. Okay, and so this goods produced in the US will be cheaper compared to goods produced in Korea, because these farmers in the US are using modern ways of producing these goods, and the cost of production is very less. And if the cost of production is less, then the price of this product will be less, right? As compared to Korean farmers that are producing these products with traditional producing materials, and their cost of production is very high. So when these goods are imported from the US because of the free trade agreement, then it's very difficult for Korean farmers to compete and win, right? Because now this product is imported from the US will be sold at cheaper price in Korea. And it is obvious that consumers will buy products with cheaper prices. Okay, that will affect the farmers in Korea. That is how a farmer or a country could be harmed in the international trade. Okay, so we'll talk more about this in barriers to international trade. There are tariff barriers and non-tariff barriers to international trade. Okay, and so we just finished the first theme from the 7, and patterns of trade is the second theme that reoccur in international economics study. Okay, so the pattern of trade describes who sells what to whom. Okay, so who is producing what and who is buying this product from the seller. Okay, so differences in climate and resources explain why Brazil exports coffee and Saudi Arabia exports oil. Okay, as I have already said, the goods that you produce might depend on the climate or resources that you own. That is why not all countries produce what they want or what their people want to consume. Okay, so the same thing, Brazil is a higher exporter of coffee because the climate and the resource in Brazil is convenient to produce coffee. Okay, but Brazil doesn't produce oil or petroleum, right? So Brazil has to import oil from Saudi Arabia, but at the same time, Saudi Arabia should import coffee from Brazil because Saudi Arabia doesn't produce coffee because of the climate and resources in Saudi Arabia, right? So both countries will be involved in exporting goods from each other, and also, I mean, importing and exporting goods from each other. Okay, but why does Japan exports automobiles while US exports aircraft? Okay, so in the first example we have said because of the climate and resources, Brazil can export coffee because, let's say, coffee doesn't grow in Saudi Arabia. But why does Japan export its automobiles? Or we can say, why does Korea exports automobile while or cars while US exports aircrafts? Okay, so this is more about the specialization of a country. Okay, so if Japan specializes in producing automobiles or cars, so the cars from Japan would be the best cars, right? And the US exports aircraft because US specialized in producing aircrafts, okay? And the other is because of labor productivity and also relative supplies of capital, labor, and land. So capital, labor, and land are the three means of production, right? We can produce goods if we have enough capital, enough labor, and enough land, right? So these are the means of production, okay? And their use in the production of different goods and services is specialized or is their specialization as compared to other countries, okay? So there, the easy to understand pattern of trade is the differences in climate and resources. The case where Brazil exports coffee and Saudi Arabia exports oil. So that's easy to understand, right? Because it depends upon your climate and your resources. But the other is dependent on your labor productivity and your specialization. Okay, so why some countries export certain products can be stem from differences in labor productivity and differences in relative supplies of these three means of production, that is capital, labor, and land. So these are the two major reasons. Okay, so let's proceed. The third theme that is most often occurring in international economics and international trade is effects of government policies on trade. Okay, so here I will just mention some points about tariff and non-tariff barriers to international trade, but there will be one big chapter where we will discuss in detail about this tariff and non-tariff barriers. Okay, so barrier means a challenge or something that hinders something from happening, right? So international trade barriers are two major classifications. There are two major barriers to international trade. One is the tariff barrier. So tariff barrier means the tax that is imposed on products being imported from other countries, okay? So for example, Korea imposes taxes on products imported from the US. One tariff barrier, okay? Why is it a barrier? Because if, for example, Korea imposes a higher tax on products imported from the US, then the price of these products in Korea will be higher, right? And if a price of a product is high, then the demand for that product will be low, okay? So those of you who are familiar with basic economics, when price goes higher, then the demand for that product decreases, okay? Then if the demand decreases, then there will not be much import of these products to the country, okay? So that decreases the international trade, okay? So tariff barriers could also be quotas. So quota means restriction on the number of imports or exports, okay? So for example, Korea could limit the number of, let's say, computers that are exported from the US to Korea, okay? Restricting the number means Korea might say within a year, I can only allow 100,000 computers to be imported to Korea from the US, okay? So that means only 100,000 computers can be imported from the US, whatever the demand of these computers in Korea, okay? So when the number is restricted to very less number of these goods imported to Korea, then that affects the consumers or the users of these products in Korea. That might increase the price of these goods in Korea, right? Then again, the import will decrease. So this is another barrier to international trade, okay? So if you ask, why do countries get involved in free trade agreement, is because in free trade agreement, then countries try to avoid, if not avoid, reduce the tariff amount imposed on products being imported or exported in free trade agreement, okay? But if there is no free trade agreement between these countries, then tariffs and quotas will hugely affect the international trade. So they are barriers to international trade. Then the other is export subsidies, a payment to producers that export or import, export these products to other countries, okay? So let's say, for example, there are farmers in the US, right? And there are farmers in Korea. Let's say the farmers in Korea, in the US, are subsidized. Subsidy means a money that is given to the farmers or companies or farmers who are producing products, right? So that's the kind of support that the government gives for the businesses, right? So, for example, if the US government gives a high subsidy for farmers, these farmers can sell their products at lower price, right? Because they have a subsidy, and if they sell products at lower price, they will not lose because the government is supporting them, right? And let's say the farmers in Korea they do not get subsidy from the government, okay? So which means they produce and they sell their products at higher price compared to the same products imported from the US, right? And obviously, the consumers in Korea will buy those products imported from the US because these products are less expensive as compared to products produced by Korean farmers, okay? So, because of this high subsidy provided by the US government to its farmers, and there is no subsidy paid or given to the farmers in Korea, the price of the products will vary, and obviously the consumers of this product will go for a product which is sold at lower price, right? So this is another barrier. We'll talk in detail about this. How does it affect import and export in the coming chapters, okay? And the other barrier is regulations, okay? So some countries, they will not explicitly tell the exporters that they don't want their products in their country, but they will set so many regulations and bureaucracies so that these investors will not be able to export their products to these countries, okay? So government bureaucracies and regulations also are barriers or challenges to international trade because they impose so many rules, regulations, and bureaucracies. So the farmers will be, not the farmers, the investors will be demotivated to sell their products to this other countries. Okay, so generally, there are two barriers to trade. There are tariff barriers to trade, and there are non-tariff barriers. Okay, non-tariff barriers are the bureaucracies, regulations, and rules. But trade barriers could be tariffs and quotas. Okay, and what are the costs and benefits of these policies? So when policies are laid out, there are costs and benefits to policies, okay? And countries always do this cost-benefit analysis of the policies, okay? So, for example, a country, as I've said, might impose or some regulations, rules, and some bureaucracies on investors so that this product could not be imported to their countries, okay? Because they have calculated the cost and benefits of this product being imported to their countries, okay? But because of international trade, because if they are a member of World Trade Organization, then they must abide by the rules of WTO or World Trade Organization, which means they have to allow international investors to export these products to their countries, okay? So because they cannot say no, they calculate the cost benefit of this product as being imported to their countries, and they might create some barriers or non-trade barriers, tariff barriers or non-tariff barriers, not to get this product imported to their countries, okay? So cost and benefit analysis is always done by countries, and there are conflicts of interest, okay, within nations and between nations, okay, which are trading. So these conflicts of interest is always calculated, and countries calculate the cost and their benefits, and they engage in international trade, okay? So some of them might deviate from the concept of being why countries are involved in international trade, because they change the issue of trade to politics or other advantages of politics, okay? So anyways, we'll talk about also this government policies in the coming chapters, okay? So continuing, then if a government restricts trade, what are the costs in foreign government if foreign governments respond likewise, okay? Then as I've said, in my example about subsidies, I said that because the farmers in the US are getting high subsidies or support from the government, they will sell their products at lower price, right? And because these farmers in Korea are not getting subsidy from the government, this is an example, they sell their products at higher price, okay? So this affects the farmers in Korea, okay? So what happens is these farmers in Korea might protest on the government, okay? And they might ask their government to give them subsidy so that they can sell their products at lower price and compete with those products imported from the US, okay? Because now it's not fair to the Korean farmers that they cannot compete in Korean market because this product is imported from the US are sold at a lower price than they're supposed to be because of the higher subsidy paid by the government to the US farmers, okay? So what usually happens is because of the protest, the government might impose higher tax on this product is imported from the US, okay? So if higher tax is imposed on this product is imported from the US, then the products will have a higher price in the market. So now these two farmers producing same products can compete in the Korean market. But the problem is, what if the US government has done the same thing to products imported from Korea, okay? Let's say Korea exports automobiles to the US, okay? So the US government might retaliate by imposing high tax on products that are imported from Korea. Okay, so at this time, this product is imported from Korea to the US will have a high price, and they cannot compete with other cars that are imported to the US from other countries, which means this Korean products will get a lower competition and lower investment in the US. Okay, so that is a kind of a conflict and a kind of problem that has to be solved between countries. Okay. Then the other is trade policies are often chosen to cater the social and the special interest groups rather than to maximize national welfare. So the other problem is governments sometimes impose taxes or they play this international trade conflicts just to attract the attention of their special interest groups. Okay, so for example, that some investors might be very influential in the politics. Okay, so these investors might be supporting that government, okay, of the country. So the government of this country, just to benefit that investor who is supporting them, they might impose higher taxes on products that have competition with this investor, okay? So sometimes it's not about the national welfare, or it's not about maximizing the national welfare, but it is sometimes to advantage those special interest groups, okay? So sometimes politics also plays a negative role in international trade issues. Okay, so governments tend to adopt tariffs, then negotiate them down in exchange for reduction in trade barriers for other countries. Okay, so as I've said, so you can play this game. You can impose higher taxes on products imported from the US and ask them, or the US government, to decrease the tax, or I mean to reduce the barriers or taxes or other barriers on products that you export to the US, okay? So it's always a negotiation, okay? So countries, they compute or they do this cost-based cost-benefit analysis, and they try to negotiate on taxes or other barriers on trade, okay? So it's a result of a negotiation most of the time. And the other topic is international finance topics, okay? So exchanging risky assets such as stocks and bonds in capital markets can benefit all countries by diversification that reduces the variability of income, another source of gain from trade. So here, let me give an example. An investor in Korea, diversification means investing in different portfolios, right? Different portfolio means an investor could be involved in producing cars, and also involved in farming, also involved in other trades, right? So this is good. When you diversify, then you will not be hit with the same problem on the same, at the same time on other investments, okay? So an investor, for example, you can take Samsung, okay? Samsung is not only producing TV, but they produce refrigerators, they produce other things, okay? So many things. And if you take LG refrigerators, TV, and they are involved in so many other productions. So this is called diversification, okay? At the same time, Korean investors might buy stocks and bonds in the US, okay? So this helps sometimes, because let's say there is an investor, a Korean investor, who has a bond or stock, which we call a capital market in the US, okay? So if the Korean economy is hit very bad and Korean economy is deteriorating, then these investors will still be better off because they have investments in the US, okay? So the economy of the US, if it is booming or the economy is very good, they can still make profits in the US, okay? So being involved in international finance, being able to buy stocks and bonds from other countries will help protect investors from being hit by same problems within one single country. Okay, so diversification will reduce the risk of being uh, affected by one country's economy. Okay, and the other is most international trade involves monetary transactions, right? As we have said, if there is international trade, there is monetary transaction. So the point is, how can you manage these monetary transactions? Okay, so we'll talk about this capital markets, futures market, and other markets. Okay, so I will give you an example. A company in Korea might buy supplies from a company in the US, okay? But they will sign a contract. So this company in Korea will sign a contract that I will pay this money after a year. Okay, this is common. Okay, for example, this is called a futures contract. Okay, so this monetary transactions has to also be managed, because what if you say I will pay this money after a year, and what if the economy of this country is in a bad shape, that you have to pay more than you are expected to pay after a year? Okay, because you know the concept of time value of money, right? So we'll talk about those issues also. And the other is many monetary events have important consequences for international trade. As I've said, cases in capital markets while you are buying stocks and bonds from other countries, and also when you are involved in futures market, then the time value of money and the contracts that you sign with your business partners might affect your international trade. Okay. And also the other is the balance of payment. Okay, so as I've said, balance of payment is you know about trade deficit. Okay, we say a country is in a trade deficit when a country has a high import and low export. Okay, and we say a country is in a trade surplus when there is high export and low import. So balance of payment, one of the factors that affect balance of payment is the import and export between countries. Okay, but you can also try to manage this balance of payment with foreign direct investment and other financial assets flow into the country. Okay, so and again we have this 40 minutes. I'll log in again. I will just give you 5 minutes this time as a break. Then we will be back discussing with balance of payment and few other issues. So we only have a few things to talk, but because of the 40 minutes limit, then I have to stop here and I will log in again. Okay, so I will see you after 5 minutes.